Welcome to FM Radio, your go-to podcast for everything in the world of funds management. Whether you're an experienced advisor, a seasoned investor, or just starting your journey, we're here to break down the complex world of funds management all in a way that makes sense. Each episode, we'll talk to the experts to get their insights on everything from asset allocation to risk management and give you the inside track on how decisions are made. So tune in and let's turn up the volume on the topics that affect you and your clients. In this episode of FM Radio, we're looking back on a quarter that has been interesting, to say the least. The USA is in an arm wrestle over the Strait of Hormuz, AI is flexing its muscles, and high fuel prices are stoking inflation. But it's not all bad news. There are some tailwinds out there, and to look at the bigger picture and provide us with a balanced view, we've brought two of Elston's portfolio managers into the studio. Welcome, Leon DeVet and David Seager.
Thanks, Pete. Great to be here.
Thanks, Pete.
You've just recently had your quarterly review. The team got together, all the portfolio managers. What sorts of things were on your mind? What were the big issues?
Yeah, it was certainly an interesting meeting looking back on the quarter. So it was one of kind of two halves. Who can forget the threat of AI on all the technology businesses that started to play out at the beginning of the quarter, but certainly the Middle East conflict, the Iranian-US-Israeli conflict was front of mind through March and really dictated where we ended up at the end of the quarter. Equities, Australian and international equities, really suffered through March in terms of a drawdown. Interestingly, international equities was a laggard, largely because of a stronger Australian dollar. But on the flip side, real assets like property and infrastructure, a little bit more immune to the threat of AI, but also infrastructure immune to the threat of conflicts, a bit more defensive, really had a standout quarter, so up over 8%. These asset classes were overweight in the portfolio. So it probably goes to the strengths of multi-asset investing, where you've got numerous baskets and eggs in different baskets and really able to spread the risk across different asset classes that react differently, even in a quarter where you had conflict on one side, but also some threats of new technology on the other. So really highlights the benefits of multi-asset investing.
So there's a fairly balanced view you've got there. There are obviously some headwinds, but there are also some tailwinds. Is there anything else out there that's of a concern to you?
Yeah, look, Peter, I think probably relative to last quarter, I think the most significant change for us really has been around the repricing of interest rate expectations and where the market thinks central banks are going to go. Our view, and I think that was probably a view shared by many, was we were going to start seeing interest rate cuts, certainly from the Fed this year. Now, clearly, that's been put on hold. We don't think that it's been put off indefinitely, but there's no question that sort of monetary policy relief has been delayed. I think importantly, though, the dominant global policy response so far has been one of caution rather than aggressive tightening. So, I think that is important to bear in mind. But absolutely, the change in interest rate expectations is a big change for us.
And you wouldn't see the Fed making a move on that unless things dramatically changed to look at interest rates. What sort of world would they be looking at moving interest rates?
I think if there is a dramatic impact on either economic growth or labour markets, so going back to the Fed's mandate, it's price stability and full employment. And so while at the moment inflation is elevated, energy prices are driving that, but the Fed is unable to fix energy prices with higher interest rates. So from our side, we probably see the Fed on hold until further notice. But should there be material economic weakness or material labour weakness, they may step in at that stage to help support the economy.
Don't disagree with David. The only other thing, I guess, if we, sort of talking just around potential headwinds, that I would note is, even though it's not in the headlines at the moment, the reality is that, trade battles are not yet over. And I think, there certainly is causing a bit of a realignment in terms of economic relationships, and exactly how that actually plays out longer term and what those effects actually are, I think, is still unclear. So it's another thing that we're just kind of mindful of at this point.
Okay, so that's a really good overview of the macro. But how are you seeing it play out in terms of specific asset classes?
Yeah, Peter, it was interesting going through the meeting together and having a look at some of the latest data that we're getting from the bottom up. So looking at the company earnings of their expected profits over the next 1 to 2 years, it's quite healthy. And in actual fact, these earnings expectations have ratcheted up in the last couple of weeks, even despite the geopolitical conflict. And so when we look at international equities, we did start the year with some pretty big numbers and they've increased. So driven by higher energy, higher material earnings. So again, related back to commodity prices, but technology as well, really getting support from that big AI CapEx spend. So really quite positive to see that earnings growth coming through. And similar to Australia, benefiting from those higher commodity prices. So a lot of the companies in the materials and the energy sector really seeing some positive revisions coming through. We are quite wary, though, on the more economic linked sectors. So think something like consumer staples or industrials, where the longer this conflict goes on for, the larger the revisions down in earnings are likely to occur. So it's one thing that we're quite focused on is the longevity of this conflict and the impact to more economically sensitive sectors.
Yeah, absolutely agree. I think that's an important point. As in fact, we've seen here, if we look domestically in Australia in the last week, we've actually had the likes of NAB and Westpac come out and increase their collective provisioning. I think that is an indication, of that weaker economic outlook. Now, as we said, we think that there's still positives, and I think we can't ignore things that are still tailwinds from our perspective. So, if we think about things like the AI CapEx boom in the US, I mean, it is an enormous amount of money that is being plowed into that economy and will help to support growth there. I think the other thing that we've got is again, in the US, something like the Big Beautiful Bill, that's definitely putting money straight back into the hands of those consumers. And, we know from history that, that will be spent. And again, that's obviously a positive for an economy. Defense spending, we believe, will still be a broader tailwind over a number of years. I think, there's no doubt that countries will have to increase defense spending, and that'll be positive. So I think there are still things out there that, help support that broadly positive view.
And you were talking about, obviously, higher interest rates. How is that affecting defensive assets?
Yeah, look, I mean, I think certainly from our perspective, Australian fixed income in particular is looking attractive for us at the moment. I think, as we mentioned earlier, there's definitely been a change in terms of sort of central bank policy outlook. In fact, if we look here domestically, the RBA has raised rates by 50 basis points in the first quarter. We've got money markets that are actually expecting probably another 2 rate hikes on balance. We've also seen bond yields, government bond yields increase. And so, as a result of that, we actually think that domestic fixed income at the moment is offering pretty attractive all-in yields, especially for the relative risk from investing in Australian corporate credits vis-a-vis places like the US.
And probably one last point to add on our real asset classes, property and infrastructure. They were the standouts in the first quarter. We suspect there's been a bit more attention being paid to them because they're quite heavy assets. So if you think back through all the inflation that's come through the construction industry, that's supporting replacement values of things like properties, but also infrastructure where there is significant moats within those types of assets. Think utilities, railroads, toll roads, airports. These things have long lead times, huge construction costs, and quite asset heavy is now a bit of in vogue given the threat of AI on asset-light businesses. So we've seen a lot of money flow into those asset classes, and hence returns actually been quite healthy in a volatile quarter as well.
Okay, so we've looked at the macro, we've looked at the different asset classes. Now, given all that, how is that affecting portfolio performance? And I guess, have we made any asset allocation decisions?
Well, within our portfolios, we've made one small change. So we pulled back a little bit on our growth asset exposure via global listed property. So that was our largest overweight asset class. So we pulled that back from 2% overweight to 1%. While that might seem like a small change, it's the direction that is quite important. So the situation has changed, obviously, with interest rates. And that was one of our pillars supporting our overweight to property. And with that now looking very different from where we were 3 months ago, we've pulled that allocation back to marginally overweight relative to our long-term allocations. We've parked that in Australian fixed income. We've touched on maybe the attractiveness of the yield on offer, and the market's already priced in additional rate hikes domestically. So we think it's actually quite an attractive opportunity to increase our allocation. So it's our largest overweight. We remain overweight bonds and underweight cash, and overweight real assets relative to equities. So we're still marginally overweight across our portfolios, but pulling it back slightly given the changing dynamics that has occurred through the first quarter.
Yeah, look, I think Dave's covered that pretty well. Not too much that I think I need to add there other than, just to highlight that there are still some tailwinds, as we mentioned early on in our conversation. And so, to our minds, a slight pro-risk stance is still justified.
So we've seen some key changes there that are obviously designed to improve performance. Yet where are we sitting with that now?
Well, across our portfolios, if we're looking at the last 12 months, our flagship portfolio has underperformed the benchmark. And that's largely due to our exposure within Australian equities. And so when we look at our portfolio, we are underweight the large end of town, which has done quite well. So that ASX 20 part of the market, dominated by the banks and the miners. And that's an area that we are underweight in.
So why are we not there?
That's I think, critically important question, Pete, because, for those that have been following us, I think you'd be aware that, two of our key investment philosophies are firstly around diversification, and secondly that, valuations matter. And certainly from our perspective, if we look at the valuations for those largest companies in the index, we do see them trading at multiples that we believe are not justified given the earnings growth expectations going forward. And as I say, diversification for us is a critical part of our philosophy. And in that large part of the index, it's really dominated by the banks and the material stocks. And so if you want to get diversification, you really have to move into that sort of, ASX 51 to 100 to get better sector diversification.
And within our income portfolios, we're ticking over 12 months since we launched them. And we've seen some really healthy returns coming through those portfolios. While the focus is definitely on income, there is a secondary mandate of making sure there's capital growth over time as well. The performance has certainly exceeded our expectations in the short term, and we've delivered income close to 4% across a multi-asset portfolio, including infrastructure, international equities. And so we've been very happy with the level of income that we've generated since the launch of the strategies. And as we roll on to the end of this financial year, the benefits flowing through from the changes we made this financial year across a number of asset classes. So we're looking forward to seeing what that looks like at the end of this financial year. But certainly the income portfolios have delivered, at least in the short term, since they launched.
Yeah, income is interesting. It's as you said, it's just had its first birthday, and it seems to have found its feet, at least in the short term, and been some really positive news. I like the fact that it's part of the Elston offering that's evolving. That's kicked off 12 months ago. There's talk about things happening in the new financial year as well. I mean, what's the next step in terms of broadening our offering?
Yeah, the process of providing choice on the SMA front has been front of mind to us. So that is just an extension of what we delivered with income portfolios last year. We're looking to launch out the core series. So keeping in the ethos of the name, it's a more core or benchmark aware approach to multi-asset investing. And while there are some differences in terms of the allocations that will be made within those portfolios, the Elston ethos and the Elston philosophy will flow through them, just as they flow through the flagship and the income portfolios as well. So we're pretty excited with those core portfolios coming to market in the new financial year. Watch the space. I know there'll be plenty of songs and dances made with the new products coming to market.
So Elston Core sounds quite exciting. We're really looking forward to seeing that happen in the future. That is the future. Let's get back to the here and now. everything we've discussed today, everything you've talked about in your quarterly review, what would be, I guess, the three key takeouts from that? What are the three key takeouts to walk away with?
Yeah, I might start with that one, Pete. I think certainly for me, first takeout is, despite all the attention on what's happening in the Middle East, the reality is we've come into 2026 from a global economic perspective in pretty good shape, and we do still have tailwinds to help support as we look to the rest of this year.
But also, Leon, the range of outcomes is wider today than it was 3 months ago. Significantly related to the duration, the scale of the conflict, and the longer it goes on for the potential more impact there is to economic growth moving forwards. That's probably a very critical point for us to keep focused on as we progress through the rest of 2026.
Oh, absolutely. I agree with you on that note, Dave. I think there's enough reason for us to still be pro-cyclical, but yes, absolutely. I think we just have to temper that given, as you rightly point out, there's a much wider range of outcomes than what there were 3 months ago. I think the final thing probably for me, and this is really more particular to Australia, I think we have seen fairly substantial adjustments in terms of interest rate expectations, the extent of rate hikes. We've seen bond yields go higher. My view is that Australian fixed income at this point in time, particularly from an all-in yield point of view, is a pretty attractive place to invest.
That's fantastic, guys. Thank you very much, as always, for your insights. I think that's a great overview of where we sit in this quarter, and look forward to talking to you again soon.
Thank you, Pete.
Thanks, Pete.
That's all for this episode of FM Radio. I hope you can join us again soon as we tune into another aspect of funds management that affects you and your clients. FM Radio was recorded at Elston House. Today's guests were Elston portfolio managers Leon DeVet and David Seager. For more FM Radio episodes and full transcripts, visit elston.com.au. And if you'd like to subscribe to our podcast series so you don't miss a thing, you'll find FM Radio on your favourite platforms, including Spotify and Apple Podcasts. The information provided in this podcast is general in nature. You must consider your own circumstances prior to making any investment. For more information, go to our website or speak to your financial advisor. This podcast has been prepared by Elston Asset Management Proprietary Limited, a corporate authorised representative, CAR 427434, of EP Financial Services Proprietary Limited, AFSL 325252.